Before we get started, just want to give you a little background on myself for those of you who have not met me before. My name, of course, is John Vento. I'm a certified public accountant. I'm also the president of Comprehensive Wealth Management, a New York City-based CPA firm as well that specializes in working with dentists across the country. I'm insurance licensed, I'm securities licensed, pretty much anything investment, tax, accounting related. If it's financial related, I got you covered. Throughout this presentation, I'm going to encourage each of you to take notes. Note down what your question is so that you'll have an opportunity to reach out to me and speak with me about what your particular question was. Please call my office. Contact information is at the bottom of the slide. Jumping to my next strategy, advanced planning strategy number 2 is pay your spouse. Many dental practice owners have their spouse work in their practice and make the mistake of not paying them a salary. You should pay your spouse at least enough to qualify for the maximum child tax credit, assuming you have children age 13 or under. If you have one child, you should pay your spouse at least $3,000, maybe more, to qualify for $600 child tax credit. If you have 2 children or more, you should pay your spouse at least $6,000 per year to get that $1,200 maximum child tax credit. Now, the nice thing about the child tax credit is that there is no income maximum. So regardless of how much income you make, even if you're making $400, $500, $1 million a year, if you and your spouse work and you have to care for your child, that care expense, that will allow you to get up to $600 for one child, up to $1,200 for 2 children. So if your spouse works for you, even if they don't physically come to your office, your actual practice, but they work for you at home, let's say paying your bills, keeping track of your books and records, if they're doing some function for your practice, you do want to put them on payroll. Even if you don't have young children at home, the strategy definitely makes sense to take advantage of. So to continue on this subject, the next slide, even if you do not have young children, you should still pay your spouse a salary for actual services rendered, so your spouse can join you on business trips as long as it is part of his or her job requirement. You can then fully deduct the business travel costs associated with your spouse. So generally, if you're going to a dental convention, let's assume you decide to go to Hawaii this year, assuming you don't already live there, and now you attend a dental convention there. Well, if your spouse is your office manager, your bookkeeper, or works in any other capacity within your practice, if their job description, if there's a purpose for them to join you on that trip, that lecture, then you could bring them along. The big thing here now is their cost of airfare, clearly the cost of hotel, you need a hotel room either way, their meals, their airfare, the car rental, all costs associated with that business travel. Since your spouse is your employee and this training session was for their benefit, for the benefit of the practice as well, then now all those things that would have otherwise not been deductible on your wife's side, those are now going to be tax deductible. So it's all these little strategies at the end of the day will make a big difference. To continue on this subject, what about retirement plans? Well, if your dental practice has a simple plan or a 401k plan, you should increase your spouse's salary even further so that he or she can defer the maximum under the plan. Please keep in mind that the salary you pay your spouse must be for actual services rendered. You cannot create a fiction there. They have to actually be working in the practice and be entitled to that compensation. Although you will still have to pay the Social Security tax on those wages, you can double the amount of tax deferral to the family through these retirement plans. So the big thing here is if you and your spouse are 50 years of age or older and you have a 401k plan in the practice, your maximum 401k contribution with the catch-up is $26,000. If your spouse is making over $26,000, let's assume you're paying them $30,000 a year for their service, they could put away $26,000. So that's an opportunity to double to the household the amount of money that you could put away towards your 401k plan. Same is true with simple plans, and we could have a similar benefit with some of the other retirement plans. And I'm going to talk about one particular retirement plan a little later on in this presentation. So employ your spouse, make sure they're doing work, pay them a more than reasonable salary, and get all the benefits of employing them within your practice. So this is the cover of my book, Financial Independence, Getting to Point X. I would highly recommend that you pick up a copy of it. It could be ordered through Amazon.com or Barnes & Noble. The book is loaded with useful financial planning tips. In addition to that, the second version, which is the green-covered book, has a new chapter dedicated to dental practices and the specific strategies you could use to save more of what you make. So with that said, once again, thank you for attending the presentation. I'd like to wish each of you the very best of success. Have a great day and enjoy.